All right, talking about tax credits versus deductions. Now, I did say we have another lesson on credits, but what's the difference? Like, obviously, they're both great, they're both beneficial. But we see that tax credits are going to be a dollar for dollar reduction, whereas deductions, they work in a different way. Both of these reduce your overall tax liability. So, again, they're good. They're both good. You want both of them. They work in different ways. And why is that? Well, the IRS wants to manipulate the tax code to make you work in the way they want you to. So, tax deductions reduce the amount of your income that's subject to tax, while tax credits provide a dollar for dollar reduction in your tax liability. Now, tax credits are generally more valuable than tax deductions because they provide a direct reduction in your tax liability. We're going to see how they work. Also, tax credits can reduce your taxable income or the tax you owe below zero, and you actually get a refund because of that, whereas a lot of deductions we'll see you can't get a refund because of them. You can't, let's say, have a $100,000 deduction, owe $1,000 in taxes, and then get $99,000 back. Doesn't work that way. So tax credits are beneficial for a multitude of reasons. But let's see how this works out. So tax deductions reduce the amount of your income that's subject to tax. So for example, if you're eligible for a $10,000 tax deduction and you have taxable income of $50,000, your taxable income would be reduced to $40,000. This means that you'd pay tax on $40,000 instead of $50,000, which would result in a lower tax liability. Now let's say that your tax rate is 20%. $50,000 times 2% is $10,000, and $40,000 times 2% is $8,000. So here we see that a $10,000 deduction resulted in $2,000 of tax savings. So that sounds pretty good. Awesome. Tax credits, on the other hand, are a dollar for dollar reduction in your tax liability. For example, if you're eligible for a $10,000 tax credit and your tax liability is $12,000, the tax credit would reduce your tax liability to $2,000, resulting in a $10,000 tax savings. So wow, would you look at that? A $10,000 tax credit, much more beneficial than a tax deduction, but hey, beggars can't be choosers. You get what you get, whatever you're eligible for. So we see how that works. This is just an understanding of how to apply these. You see them on the exam. And then, of course, each credit and deduction has its own special caveats and rules for them. So we'll see that as we go through. Let's keep moving along. Phase outs. All right. We are introducing ourselves here. We're going to see phase outs in actually so many things throughout the exam. Whether it's credits or benefits or deductions or anything like that. The concept of a phase out, that's what we're covering here, kind of just like we just covered the concept of deductions and credits. Now, these refer to the gradual reduction or elimination of certain tax benefits, deductions, or credits as a taxpayer's income increases beyond specified limits. Essentially, the IRS doesn't want you getting these benefits if you make too much money. Phase outs are designed to target tax benefits to taxpayers within certain income ranges and prevent high-income individuals, those damn high-income individuals, from claiming tax advantages that are intended to assist low to moderate income taxpayers. Now, for example, let's consider the adoption credit, and this phase out here we're going to use. This is not the accurate phase out credit. This is just obviously it adjusts for inflation every year, so just keep that in mind. We do have the accurate phase out amount in our resources, so you can reference that there for sure. The adoption credit, it's a non-refundable credit of up to $14,300. Again, this is not the accurate amount for the year. That will be in our resources as well when you get to the credits lesson. This is just, again, how it works. Don't worry about the actual adoption credit. We're using that as an example of just how phase outs work. So this is a credit of $14,300. It's a pretty hefty sum, but hey, also adopting and raising a child is pretty expensive, so it probably doesn't offset too much in relation to that. Now, let's say that the credit begins to phase out for taxpayers with a modified adjusted gross income of $214,520 and completely phases out at $254,520. Now, how does this work? Suppose a taxpayer has $10,000 in qualified adoption expenses, and we've got this modified adjusted gross income, but it's in between these two amounts. So we see here, it's in between, and that's really the kicker, because let's say you've got a modified adjusted gross income below 214, well, you get the full amount. You get the full amount. It's nice and easy, right? There's nothing really to worry about. And if you make more than the upper threshold of the phase out, then it's completely cut out. You don't get the credit at all. So those two parts are easy. Again, let me repeat that. If you have a magi, whatever, however you want to say it, modified adjusted gross income, that's just a mouthful to say, below. Now, for any of these phase outs, we've got phase outs for so many deductions, so many credits. If you've got that adjusted gross income below the amount, you get all of it. If you have above that amount, you get none of it. But if we fall in between, that's where we start to see, okay, how does this work? Now the phase out range is $40,000, which is the difference between these two here. We see, all right, that's a $40,000 difference. So first step when you're dealing with phase outs is what's the difference, right? Here we see it's 40,000. In some examples, it might be $50,000. It just depends on the particular item tied to its specific phase out. All right, phase out range $40,000. In this case, it exceeds the lower threshold by $20,000. We see that we have our modified gross income of $20,000 more here. So in this case, we are going to get 50% of this cutout. So we see the overall difference between the threshold was 40,000. We are 20,000 over the bottom threshold. So 50% here. We get 50% cut out here. So as a result, the taxpayer would lose 50% of the adoption credit. Now, this is how it would work with most phase outs also. You would lose 50% of whatever the benefit is. Reducing the credit from $10,000 to $5,000. We see here, now, even though you're eligible up to that, right, you only had $10,000 in qualified adoption expenses. So you'd only be able to take up to $10,000, but 50% of this is eliminated because you're making too much money, making too much gains, bringing those home to the house. So we are going to actually only be able to take $5,000 here. If the modified adjusted gross income were within the phase out range, the credit would be further reduced based on the percentage of their income above the lower threshold. So we see, if it was 25,000 over, it'd be 25,000 divided by 40, and we'd get that percentage, right? We could just keep rolling with that. Now, phase outs are applicable to various benefits. Again, we'll see this so much throughout the exam. We've got them all constantly updated, adjusted for inflation for your current year for your exam. So keep that in mind and reference those in the resources as well. They help to ensure equitability, all that, sure, whatever. It's at the end of the day, it's what the IRS decided, so we can't really argue about it. That's just how it works. All right, and that's how phase outs work. Feel free to reference this video as you get to other lessons and you see phase outs again. If you want extra practice on it, feel free. We're here for your benefit.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.